Good evening, good morning, good afternoon, wherever you're watching or listening to us from. You're welcome to Stalker Team, the Investors Channel. Today, the 21st of March 2025, we are happy to close this week of investing and trading on Wall Street and, of course, around the globe by bringing you this update. Before we just go ahead, let's just make our usual disclaimer. Every information shared on this channel is for education and information purpose only. So do your own due diligence or consult your financial advisor before making any decision. Thank you so much for joining us, for watching, and also subscribing to our channel. If you haven't subscribed to Stalker Team, the Investors Channel, please subscribe. Put on the notification bell so that any update that we're bringing to you, either over the weekend or during the trading week, you don't miss any updates. Also join us on Stalker Team Live on X. We have a community on X where we share all the breaking news that moves the market and, of course, your portfolio. Today I just want to look into a recap of what exactly has been going on in the broader market scheme of things. So some of the feedback that I've gotten so far is that despite the fact that a whole lot of investors saw a drawdown or weighted drawdown on their portfolio value since the new president in the US took charge, the tough talking, the banters, the tariff threat or tariff war that's been going on, even when they keep pushing the date for the execution of those tariffs, but there's still that anxiety that are we de-escalating or we are escalating? But in the financial market, there seems to be an admission that we are now at a point where the market is not necessarily going to really pull back, because the market has really put into perspective all the risks, all the drawdowns that we might have. The market has really pulled back, but we've started seeing that uptick. A whole lot of the stocks that moved down by 30, 40%, 25%. Many of them have actually gained close to about 15% back, or some of them have even gained close to about 20% back, some 10%. And there was a very golden opportunity for a whole lot of investors to have even buy more or by averaging down on some of those positions. So the question I want to answer today, which is the elephant in the room, is the stock market back? Is the stock market now on the path towards gaining momentum, and we have another bull run that could take us to another all-time highs, either on the Nasdaq 100, either on the S&P 500, which is the bellwether of the of Wall Street. So I'm going to paint some background to why I think we are actually on the path to actually having another bull run. And the number one reason why I think so, I believe we have actually put the worst behind us. I believe the market has fully priced in the risks. So if you see the chart I'm going to be showing you in the next couple of moments, you will actually perhaps maybe do your own due diligence or also do some more research, and you might actually perhaps come to the right or the right answers for yourself, or agree with me that we have actually seen the worst this year. And I don't necessarily think that we are going to see another sell-off, at least. A whole lot of the tough talking, a whole lot of the threat of trade war, tariff war has been pricing already, and that rearrangement has already happened in the market. And I see we turning the corner, and we started seeing the uptick. Also, we didn't really see any rotation out of tech stocks, the likes of Nvidia, Google, Microsoft, Tesla to an extent. Tesla has its own nuances why the stock pulled back because of the political risks and the key man risks with Elon Musk and all that, and his exposure to Doge and everything he's doing with the current president. So Tesla has specific risks built into that stock. But if you look at the remaining stocks on the Magnificent Seven list, Google, which is Alphabet, Nvidia, Meta, Amazon, Apple, these magnificent stocks are now more or less at a capitulation or a consolidation phase. That might look like a bogus, something that what am I actually talking about? I'm actually saying these stocks are not necessarily going to pull back beyond where they are. As a matter of fact, they are actually at a stage when they are preparing for another move, because now we are going to be having in the next couple of weeks the first quarter result for 2024, and we're going to be seeing a whole lot of positive move, because I don't necessarily think the investment into AI, the a whole lot of interest into cloud and AI is not going to yield or start yielding result. So I don't see any major rotation out of tech stocks. There was just a broader market sell-off, and a whole lot of people, a whole lot of big investors put more money in cash than into equities. The another point I wanted to make is, if you look at the US 10-year, the 2 years treasury yield, they are actually pulling back because the market is actually believing that inflation is not going to be too powerful. As a matter of fact, the last reading of inflation, the CPI number coming out of the US, saw a lesser than expected percentage of inflation dropping. The Federal Reserve has already telegraphed that they will be doing about 2 rate cuts this year. Is it going to come earlier than June, or are we going to have those 2 rate cuts towards the end of third quarter or the fourth quarter? We wait and see. However, if President Trump and Mexico, China, EU, if they get to a round table and they work out a deal, I believe inflation is likely to further tick down, and we might even have maybe another 1 cut, making it 3 rate cuts this year. So how is this important for you as an investor? And this is the most important part of my topic for today. You don't necessarily want to buy stocks when the rate cut has been confirmed. You want to actually buy when the pessimism still pervades the market, because that is the point where you tend to buy some of these stocks at cheaper valuation. You tend to actually go on bargain hunting to actually buy and take better positions. So at the likes of Meta, I've spoken about Meta. I called Meta a few weeks ago, or about a month ago, or I called Nvidia. I also called Alphabet. Those 3 names are in the Magnificent Seven. They are now at a point when you can continue to average down what you already have, or see how you can take position, because you don't want to actually run after the market when it's actually up. I also believe the US is going to avert a recession. I don't see the US falling into a recession, because it's not going to augur well for the political side of things. President Trump trying to actually make that statement that it's going to make America great again. I don't necessarily think it's going to allow a recession to taint that. Even when you can't actually hope on politics or politician, but there's so much to actually lose on the political side of things. On the economic side of things, the dollar could actually see a whole lot of sell-off, which will actually affect a whole lot of things, even for the average American. So I don't see a recession. So if we avert a recession, if we have more rate cuts coming, that is really a bullish move. So as an investor, you don't want to time the market. And I'm going to close on that note before I go to my chart. As usual, you don't want to time the market. You want to spend time in the market and not time the market, because when you time the market, you are actually running after the market instead of you taking the market to the cleaners by buying a whole lot of valuable stocks at a very, very good valuation that you can actually build on top. So let's go to our chart for the day. So before I close, I want to actually show you this chart so that we can have things into perspective. One of the most talked about mega cap stock in the Magnificent Seven list is Nvidia. This year, at least between last year and this year, Nvidia has been much talked about, even more than Apple. Winning Apple as is the most capitalized or valuable company, and now Apple has pushed it down. But Nvidia is still much talked about because Nvidia has much more relevance as we speak, because Nvidia is the engine room driving the AI revolution, the AI boom. So if you look at this chart, you will actually see the Nasdaq Composite, which is the tech heavy index on Wall Street. You can actually see that the last 1 year, the rise in Nvidia actually is directly correlated with the rise in the Nasdaq Composite. So if you take memory lane, if you go back in memory lane and you go back 5 years, you could actually see that almighty Nvidia outperformed the Nasdaq Composite. And what that means for me is that I don't necessarily see that the tech story is done because of a new president who is trying to talk tough, who is trying to cut deals, who is trying to be transactional, by his own words, trying to make America great again by doing deals that is going to put America at a better position. That is his own goal. But the stock market always exists in its own right, and technology will continue to actually drive growth. So if you are trying to invest at least for the next 3 to 5 years, I don't think you should actually be in a state of despair, because if you look at year to date, just about 7% drawdown in the Nasdaq and about 12% drawdown in Nvidia. 1 year ago, these two stocks are still very much positive. But if you look at, just take a look back and zoom out properly, you can actually see on a 5-year, Nvidia outperformed. The Nasdaq itself did very well. The most capitalized index is doing very well. So as an investor, you have nothing to worry about per se. This is actually the best time, because if all of the factors that I've actually mentioned, from the tariff war now priced in, the possibility of having 2 rate cuts or even 1 more rate cut, which is actually a bullish sign for the market, because if interest rates are lower, people tend to take more risks, people tend to buy more products, people tend to consume more. And what that means for the likes of Nvidia, Apple, Microsoft, Meta, Alphabet, Netflix, a whole lot of consumers feel much more relieved to spend more because they pay less. When they use your credit cards, they even take more risks. So if we are going to have 2 rate cuts this year, or another one making it 3, those are bullish moves. And that's why as an investor, you don't want to time the market. Like I said, you want to spend more time in the market. So just to bring it to a close, that's what I think. I think we are on the pace to come back for a bullish move, which could happen anytime as early as the second quarter of this year. A whole of the catalysts I've spoken about, the negativity has now been normalized. That's the way the market works. The market escalates and then de-escalates. Negativity has now been priced in, and there's just so much more positivity that we can have now. So you don't want to time the market, you don't want to be reactionary, you want to be proactive rather than reactive. Thank you so much for watching Stocker Team today. Thank you for being part of this journey, being part of this channel. We love everyone wherever you're watching us from. Please subscribe to our channel if you haven't, and share this video with anyone you want them to grow. You want them to actually invest in their financial future, just like they invest in their health and in their well-being. Follow us on Stocker Team Live on X. Thank you so much. Please have a lovely weekend till next week when we meet. Keep investing, keep growing. Take care and bye bye.